I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Tale of 2 years. ETF flows show caution reigned for most of this year until risk took over in November. How does that set us up for 2020? We get passive-aggressive with the big three. BlackRock, Vanguard, and State Street sound off on what's fueling the fire of ETF adoption. And the holiday season calls for an ETF whose motto may as well be, let the good times roll. Now, when you cover the ETF industry, big numbers are par for the course, and our in-house ETF analyst, Eric Balchunas, is used to big numbers. His ETF podcast is called Billions? No, Trillions, I'm kidding. And 3 commas regularly comes up in discussion when we talk about flows as well.
That's right, and this is no exception. Thank you, Scarlet. This is the end of the year, the last show. So normally we go over weekly. Let's go over year to date, and the numbers are big. First of all, let's look at the total year to date flows, $324 billion. That'll be the second biggest year of ETF flows ever. 7% organic growth so that's nice, steady growth. Let's look at the top leaderboard of the year, right? VTI, broad market, everybody just piling in. VU, that's S&P. Look at that, 31%. That's the best return for the S&P since 1997, even though it didn't feel like that all the time. USMV is a shocker. This should not be this high. Minvol was a huge breakout this year. That's interesting for smart beta. And then also note VU above IVV. It cut its fee by 1 basis point. That was enough to sort of win this little internal flow battle. And look at all the bond ETFs on there. That's that hangover from 2018 and rates falling. Let's look at the asset classes. For the tale of 2 years, you can see January through October, equity is not that big. Look at them, 40% of their flows in the last 2 months. But look at international, more in the past 2 months. Fixed income, look at that versus look at that drop off, right? And then gold as well, drop off. But look at their growth this year. A little below average, but look at that. 18% for fixed, that's way above average. Its biggest year ever. Also gold, not slacking there. Now let's look at the leaderboard in terms of the issuers who won and lost. And for the 6th straight year, BlackRock will have taken in more flows than anyone else. Vanguard was flirting with winning, but BlackRock pulled ahead. Schwab, always number 3. But don't sleep on JP Morgan and Goldman as we move forward. These two and Deutsche Bank, the Wall Street banks, are very good at taking in money. So, Scarlet, look, interesting year. The end of the year reminded me of 2017 with everybody feeling bullish. Next year should be very interesting. Yeah, everyone's breathing a sigh of relief. It's not like the end of 2018. All right, Eric is not our only ETF savant here at Bloomberg. I want to welcome Athanasios Sarafagis, our ETF analyst for the EMEA region, and James Seyfert, our New York-based ETF analyst. James, let me start with you. Eric shared his tale of 2 years, and he mentioned fixed income, but maybe he didn't do it enough justice because it was a record year for fixed income, wasn't it?
Yeah, this was the biggest year that fixed income ETFs have ever seen. And within that, we've seen junk bond or high yield ETFs taking more money than they ever have at 20 billion. Muni ETFs have taken in a record number at 10 billion. And what this is more a story about investors and institutions getting more comfortable with fixed income ETFs as a whole. And we see this is going to go forward.
Yeah, and Tom, let's talk about, you did a summary of the whole decade, right? It's the end of the decade, too. Talk about the winners and losers performance-wise of the decade.
Yeah, I mean, if we look at the 2 decades, right, so let's look at this first one. It's been all pro-growth, pro-America, right? Semiconductors, medical devices, internet stocks, defensive names, right? That's what's really led this decade. If you look at the decade before, 2000, 2010, it was all energy, XLE, and any country that was tied to energy. So like Mexico, Canada, Australia. So very different decade. The second half of it, very pro-growth, very pro-America.
Okay, so very commodity-driven, certainly, in the previous decade. It brings to mind what's going to come up in 2020 and the decade to follow. And I suppose one thing that you can look at is smart beta, because the inflows into smart beta have reached $1 trillion. There's that 3 commas.
Yeah, so record year for smart beta, reaching $1 trillion, just as we have these ants, or active non-transparent, hoping to come in. Talk about this interesting turf war over the future of active, smart beta versus non-transparent active.
Sure, I think smart beta fills a lot of that void, right? And you sort of mentioned USMV, right? So that putting smart beta assets over $1 trillion, that's a quarter of all ETF assets. So now when you think about these active non-transparent, they're not only competing with just really cheap core, they're competing with smart beta. I think that's really who they're competing with. And then if you also look at just over time, smart beta costs have come down a lot, right? So they're going to be competing on these really cheap smart beta products. When they start coming in.
James?
Yeah, I mean, you can't really sleep on these products because, one, there's trillions of dollars. There's asset managers with trillions of dollars betting big on these things. And also there's other ways they can gain assets. If they convert some of their mutual funds that are seeing outflows in a way to stem outflows to these ant products, that could be a way that these things could get assets real quick.
Okay, so it could be a big secular change for that part of the investing world. One thing I feel like we need to talk about this year is ESG, because it feels like it went mainstream this year. I mean, people are talking about it a lot more.
Yeah, that's the word on the street. I hate to be the bad guy. It's tough to be
You're
against.
skeptic.
I know. ESG definitely doubled its assets this year, but it's still only 0.4%. Given the hype, I think that's underwhelming. And also, we did a study. What ESG ETFs don't include, a lot of them don't have Amazon, Netflix, Berkshire Hathaway. I think people are going to be kind of shocked. I think a lot of education is needed. James, you're a little more bullish. Give me the bullish case for ESG.
Well, for one, they've taken in $8 billion this year, which is a big number, especially for ESG ETFs. Again, not huge in the grand scale of ETFs. But the way I look at this is similar to the way that I look at smart beta ETFs. The watered down things with a lot of beta are getting all the assets. The newer ESG ETFs are similar. They're excluding a couple of assets, a couple of securities. And also some of the companies that Eric mentioned are more, there are some real governance issues with them. So it makes sense if you're going to go ESG that they would be excluded. But again, we're a little more bullish on the ESG type of, the watered down ESG type products.
And Tom, of course, ESG is much bigger in Europe. It's a lot more developed there.
It is. They seem to be a little bit warmer to ESG. Maybe about 5% of assets are in ESG ETFs in Europe versus like less than 1% here. And the other thing, a lot of it is regulatory. So even benchmarks now in Europe all have to disclose their ESG rankings. So a lot of it is just being pushed into that direction. And then also here in the US, the products that took in a lot of money, the bespoke funding, that was a European pension fund that was putting money into it. So it's just, they're just being driven towards that. So that's why it's taken off a little bit more in Europe.
All right, and of course, final point here is that there have been some big numbers associated with calls for ETF flows and assets. And B of A Merrill Lynch's Marianne Bartels, Eric, has a big number out there. And you put it out to Twitter to see if everyone would agree.
Yeah, and I have a lot of people who are in the ETF industry who follow me, but I was shocked that many people agree with her that 50 trillion will be what they have in 10 years. I'm more in the 20 trillion camp. What do you guys think?
I'd probably take the under on that. I think there's a lot of things, also in the last 10 years, if you factor in the growth rates, a lot of it was the market too. So, the market might not be as might not have that big bull run that we had in the last 10 years. So I'd probably take the under on the 50 trillion.
I'd probably put, if I had to say a number, I'd say 25, but that would be pretty bullish on international markets.
Okay. All right. Final question to all of you guys. Lightning round. What is one ETF that you're watching in 2020 and why? Eric, we'll start with you.
B-Bus from JP Morgan, because they have 23 billion in SPY, and if JP Morgan moves even a little bit into B-Bus, look out. That thing could be a multi-billion-dollar ETF.
James?
I'm going to cheat a little bit and go with a group of funds or defined outcome funds. Innovator Funds was the first one to come out with them, and basically they buffer you against a certain percent of losses. They cap your upside, but it could be a way for ETFs to compete with structured products and annuities going forward.
All right, UGen, BGen, and PGen are examples there. And Athanasios?
I'm going to go with Goldman's GSLC. It's already a big product, but I think one big difference for them next year is they bought United Capital, they bought S&P Model, so they have a lot more distribution going into next year that I think they can place that product in.
All right, GSLC, B-Bus, and those defined outcome names. Our thanks to everyone involved, James Seifert of Bloomberg Intelligence, Athanasios Sarafagas of Bloomberg Intelligence, and of course, Eric Balchunas. All right, coming up, you will hear from some of the biggest names in the ETF industry. We're talking about executives from BlackRock, Vanguard, and State Street giving their take on the year ahead. And one fund that caught our attention this week has to do with SPY. Investors are throwing caution to the wind, betting the S&P 500's record run isn't stopping anytime soon. According to data from IHS Markit, short interest on SPY fell to the smallest percentage since October 2018. And a reminder, you can find that and all our other charts on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Let's get to the ETF life cycle where we talk you through the three main stages of ETFs. And step one is the filing. New issuer Volatility Shares registers the negative one-time short VIX futures ETF. It'll be similar to the infamous XIV, which collapsed in February 2018. But the new fund, ticker SVIX, has some minor differences, starting with the fact that it's an ETF, not an ETN. Step two is the launch. The RPAR risk parity ETF began trading. The actively managed fund invests tactically using a risk parity approach to target a combination of TIPS, treasuries, global equities, and commodities. The folks behind this fund, alums of Bridgewater. And for some, the final stage is liquidation. The Tortoise Cloud Infrastructure Fund is shutting down. Ticker TCLD was passively managed and invested in cloud infrastructure stocks, including Splunk, Microsoft, and Alphabet. Investors, though, never quite bought in. Let's get passive aggressive and track the tensions between active and passive investing. Now, this month, I sat down with the ETF chiefs of BlackRock, Vanguard, and State Street to wrap up the big themes of 2019 and look ahead to 2020. Here's part of my discussion with Armando Senra, head of iShares America, Rich Powers, head of ETF product management at Vanguard, and Noel Archard, global head of Spider product at State Street. We began with a shift to passive.
It's been a good run. But you know what's going to, I will never actually wish for this because that would be a horrible thing, but it would take a pretty significant market correction for some of that money to shift. Because you're talking, you know, maybe 90 bips of portfolio savings, but what's the tax hit and what's the holding period? So people are doing that math, and we have a lot of conversations with clients that are sort of biding their time because they see how they could use some of these beta products in an active construct or, you know, an active strategy that they're deploying, but they've got to be sensitive to, you know, in the retail space, to the tax ramifications.
Absolutely.
But we know that one of the great catalysts for the adoption and acceleration of ETFs was the global financial crisis, right? That's when investors recognized that what they were paying for in many expensive products was not being delivered, be it outperformance or downside protection. And so switching to a lower cost product where you knew what you're going to get from a performance standpoint, good or bad, led investors to consider ETFs. And so we know the market's going to trend down at some point, and it could be the next wave, could catalyze the next wave of ETF adoption.
All right, so market turmoil could be the catalyst.
Yeah, I also think that we're moving from a time when we used to talk about active and passive, when the reality is now, when you see the growth, for instance, of factors and thematics, you have many instances where ETFs are instruments of active returns. So I think investors, the more that they understand that, the more that they're not thinking just about index in terms of cap weighted, but they're moving into factors, they're moving into thematics, they're looking for alpha in the index world.
Yeah, and so just to continue on that theme, and you mentioned sort of the crisis. That's been such a big part too of the growth of ETFs, not just that point in time, but you think about how many firms took a step back and said, you know, just from a how do we want to run our book of business? Do we want, you know, if you think about the wealth management business, do we want wealth managers or brokers out there sort of doing their own investing or, you know, acting as PMs? Or do we want to try and push models down from on high that just says, look, the asset allocation is really critical. We've got a bunch of very smart people sitting here that can create those asset allocation models. Use these for your clients and go out there and then make sure you're servicing and taking care of the estate planning and the tax issues and the stuff that, you know, adds another layer of return for the client. And the ETFs were a really, really good vehicle to execute upon those you know, very active allocation plans with a diversified low cost vehicle. And that you know, was part of that hockey stick growth.
So using these passive products in an active way, using an active mindset to apply these products. Let's talk a little bit about the zero-fee trading platforms, because in any discussion of cost, this has to come up. The list of places where you can trade stocks or ETFs for free is getting longer. Wells Fargo, Wells Trade this week, Bank of America's Merrill Edge, Charles Schwab, TD Ameritrade, E-Trade, Interactive Brokers. For you guys at BlackRock, Armando, isn't this bad news when you had an exclusive deal with Fidelity to sell your ETFs for free, but that edge is basically gone now?
Yeah, look, I mean, I think that this is positive for ETFs. This will expand the use of ETFs. The more that we can remove the friction that a client has in utilizing ETFs to build portfolios, to gain exposures, this is positive for the industry. So I don't see this as a negative to us or to the industry. This is a real positive. We'll help. The biggest beneficiary are the clients, and clients will continue to use ETFs to build portfolios. So I see this as a positive.
I think it accelerates greater ETF usage from a variety of client types. Financial advisors, on average, 20% of advisor assets are in ETFs today, according to the Sterling research, thereabouts. And so you look at ETFs relative to a mutual fund, increasingly the ETF is going to look like a better option because that friction around commissions doesn't exist for ETFs, may exist for certain funds they want to consider. And then even the individual investor. The individual investor who doesn't have an advisor, it uses ETFs in a relatively small way today. Again, they now can consider an ETF at zero commissions, at a low expense ratio, whereas a high commission might be placed on their mutual fund they want to buy on one of those platforms. So I think this is only more fuel to the fire in terms of more ETF adoption.
All right, let's talk about how some indie issuers complain that the ETFs that they launch, the cutting edge ones that they launch, some good ideas, the thematic ones, they do a great job of it, but they don't have the distribution, they don't have the awareness that you guys do. And as a result, it's something that you guys look at and you copy it and you put it out there with a lower cost and it does a lot better. Are you ripping them off?
Don't look at me.
I'm looking at you.
I think you did it to us. Not worried about the little. Anyway. I did it to me. I'm not sure. I've worked at all three at this point. So I don't know if I completely agree with that. I mean, look, all of us, anyone in this business is constantly looking at what the competition is doing. And you might see something that there are a couple funds that have taken in some decent flows over the last year or so that have been down a different road. And that's great, but if it doesn't fit your client or the way that you distribute or your brand, it doesn't. You're not necessarily just going to say, oh, let's just go in there and I'll just drop this product in and try and grab some assets, because it probably doesn't fit with your range or your way of interacting with clients. The flip side of it is that we'll have clients come to us and say, like, hey, there's this thing, it's interesting. I think about it slightly differently, right? Is there a variation of the theme that you'd be willing to launch? We like this weighting better than that. We'd like this part of the market included and not. So I think you see variations, and that certainly happens.
That was State Street's Noel Archer, Vanguard's Rich Powers, and BlackRock's Armando Senra. This is Bloomberg. I'm Scarlet Fu. This is ETF IQ. Now, for every ETF that offers exposure to a country or sector, others are usually quick to follow. How about when you combine the two and end up with a factor to boot? Yang Xu is CEO of FinTech Asset Management, and he has a fund tracking the biggest U.S. and Chinese internet names, embodying growth. But before we talk to him, Eric Balchunas is going to give us the drill down into Yang's ETF.
Thank you, Scarlet. TTTN. It's the FinTech China-U.S. Internet Titans. It's very simple to understand. Biggest 10 internet companies in the U.S. and China combined. Pretty small, 10 million still, but fairly new. 59 basis points, which is a little cheaper than KWeb, which is probably the biggest peer. Let's look at the holdings. And it really combines FANG and BAT, right? Baidu, Alibaba, Tencent, and FANG, here in the U.S., and it with some smaller companies as well. And here they are. I mean, everybody knows these names. So I think these are where a lot of the action in the internet growth is. Let's look at it versus two peers, which I thought were probably closest. One of them would be KWeb, which is only China. And then this O-Shares one is global internet. So you can see here the differences. I think the main thing you want to point out is how concentrated this is. So more zip here. And also you're going to see 50% China exposure. These are sort of in the middle. So Scarlet, I think this is one of these ones that performance will mean a lot, but it is unique exposure with just the two countries.
It always comes down to performance. All right, still with us is Yang Xu of FinTech Asset Management. Talk about the case for putting together Chinese and U.S. internet names in this fund.
Right. So when I say in physics, it's always about time, space, and mass. So when I say it comes into investing, time, space, and internet. Internet connects everything. And then when I look at the global landscape, what are the two countries that I want to invest in the next 10, 20 years? I think US and China, the two biggest economies around the globe. And then in China, they have 10 biggest internet companies. In the US, 10 biggest companies, easy to understand. And then also have to understand that's our customers. And then we have to find out a thesis that can fit into our customer.
So who is this fund designed for? Is it designed for American investors or Chinese investors?
Well, we initially started with Chinese investors. The investors in China, they want to invest in the US space. So our customers, they are working professionals whose firm went public in the US in the last 10, 5 years, and everybody wants to invest into the US equity stocks. But it's complex, right? I have 2,000 ETFs in the US, 2,000 stocks in the US. How are we going to find out a good thesis to invest? But that's what we create, the China-US Internet Titans ETF.
Yeah, and just real quick, your company isn't just an ETF. You're trying to be like the Schwab or Interactive Brokers of China.
Right.
Explain what you're doing there.
Well, initially we started as a commission-based business. It's a brokerage business, facilitate international investing. But now, giving all the commission wars, we need to start with a fee-based business. So that's how we create our own ETF and promote that among our customers. They can buy our ETF commission-free at their fingertips through the mobile app we have.
Are local investors in China moving to ETF the way that they have picked it up in the US? Because growth there has been okay, but it hasn't been runaway like you might think it would be.
Well, we've seen the regulators and institutions in China pushing towards that direction. People want better efficiency. They want transparency. Only thing they don't have in China is the capital gain, right? There's no capital gain. However, people still want low-cost, transparent, efficient product. This year in China, there are about 250 ETFs. Last year, it was only 180. So we're seeing a 34% growth in terms of number of ETFs listed in China.
All right. Well, cost and transparency, it always comes down to those factors. Yang Xu of Up FinTech Asset Management, thank you so much for joining us
Thanks
today.
for having me.
Appreciate it. Now, the ETF industry has you covered with something for everyone. So here's a fund that Clark Griswold would love. It's time to close out the year in style with some fun and diversion, some whining and dining. PEJ is an Invesco fund that tracks 30 U.S. listed companies involved in the leisure and entertainment industries. The consumer-facing names are chosen according to specific criteria, including price momentum, earnings momentum, quality, management action, and value. You've got gaming and media companies, hotels, along with cruise operators and airlines. Names such as Fox, Booking Holdings, MGM Resorts, and Hilton, to even Manchester United. PEJ uses a multi-factor selection process that is equally weighted within tiers. With some $40 million in assets, PEJ has an expense ratio of 63 basis points. Since launching in 2005, it's returned almost 240%. Even so, that trails the S&P 500 by some 20 percentage points. PEJ gets a green light in the Bloomberg Intelligence traffic light system, with one warning for its alternative weighting system. See, I can see Clark Griswold getting all over that kind of fund.
Back in the day, somebody actually called this the Clark Griswold ETF. There used to be way more wild articles back in the day. It's calmed down a bit, but that's what this one was called. They actually, so you're not alone.
It catches the spirit, definitely. That does it for Bloomberg ETF IQ. Happy holidays, everyone. From New York, this is Bloomberg.